Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Now we're talking about capital investments. This one's pretty important. Pretty important concept in finance in general and for the curriculum and the exam. So we're going to make sure we really understand it. Really, the key learning points from this module are discussing NPV or net present value and IRR or internal rate of return on investments. So these are two metrics that are commonly used when evaluating capital projects. Or expansions or something like that, right? We'll be asked to calculate the NPV and IRR for different projects when we're given a series of cash flows, whether the cash flows are conventional or unconventional. But generally, they can have equal cash flows every year, unequal cash flows every year. Totally depends what it is, but we'll go over some calculator tips to make sure we're leveraging our calculators to the full extent and save time on the exam. We'll also be asked to rank projects, rank mutually exclusive projects in particular, based on their NPV and IRR metrics and decide based on these metrics which project the company should go for. And we'll also talk about how the NPV theoretically impacts a publicly traded stock share price. So, like I said, pretty important for the exam. It's not really that quant heavy. Like if you know how to use your calculator, you can get this done really easily. It just takes some practice. So we'll jump in and clear this stuff up. A USD 2.2 million investment will result in the following year-end cash flows. We have 1.3 mil in year one, end of year one, 1.6 in year two, 1.9 year three, 0.8 year four, using an 8% opportunity cost of capital. And this is, they give the wording to you in this question, but it is important to note that NPVs are discounted at the opportunity cost of capital, not necessarily like a weighted average cost of capital. So it has to be particular to this project. But anyway, pretty simple calc here. We have the cash flow, so we have an outflow of negative 2.2. Negative 2.2, so this will be year zero. Year one, we have it here, 1.3, 1.6, 1.9, 0.8. Year two, year three, year four. So you could discount all of these back individually. I like to use the calculator with the cash flow function. I went over this in detail during the very first learning module, time value of money. But as a quick recap, you can basically hit CF on your cash flow, or on your calculator, and you get CF0 come up, which is going to be the negative 2.2. So this is CF0. So enter negative 2.2, hit enter. 1.3 is CF1. So if you toggle down on your calculator, just hit the down arrow. You get to CF, or I guess CO1 is the notation. And you're going to enter 1.3. And then if you hit down, F01 is 1, because this is the frequency of this cash flow, so it's just occurring for 1 year. And then, kind of going down the list, you can see how this is 1.6 is CO2, the F02 is still 1, this is CO3, F03 is 1, this is CO4, F04 is 1, because all of these are just occurring once. Then you can hit NPV, enter in 8% cost capital, and compute the NPV, and you get an NPV of 2.47 million. Here we have a 3-year investment that requires an initial outlay of £1,000. It is expected to provide 3 year-end cash flows of 200 each year, plus a net salvage value of 700 at the end of 3 years. Its IRR is closest to what? So this one I'll go over in a bit more detail. I'll have the calculator up down below. So first thing you're going to do is you're going to hit CF on your calculator, and then you'll get this menu pop up. Quick note, if you still have the stuff, like the numbers that we entered from the last question, you're gonna have to press second, and at the bottom left there's clear work, and that'll remove all the cash flows. So anyway, we have everything cleared now, and for CF0 we can put negative 1,000, enter, hit down. So maybe I'll write it here too. So CF is negative 1,000, and then CO1 is 200, and the frequency is going to be 2 years, because what we're going to do, I'll show you in a second. So F01 is 2, so we have this 200 occurring for 2 years, and then in year 3 we're going to have the 200 plus the 700, so 900. So we got that set up. So F01 is 2, hit down. CO2 is going to be 900, 200 plus the 700, and F02, so the frequency is 1 year. Let's enter that in. And then what we're going to do is hit IRR, hit compute, and we get 11.02%, which is B. An investment of 100 USD generates after-tax cash flows. Once again, it's not relevant for this question, but do note that NPV analysis always deals with after-tax cash flows. So anyway, 100 investment, we get $40 in year 1, 80 in year 2, 120 in year 3. The required rate of return is 20%. What's the NPV? You can do this one a little bit different. You can still do it on the calculator, but you can show multiple ways. So the NPV is going to be the negative 100. So the present value of this is 100 because it occurs today. So it's a 100 outflow plus 40 over 1 plus 20%, which is 1.2 to the power of 1, plus 80 in year 2 over 1.2 to the power of 2, plus 120 over 1.2 to the power of 3. And if we run that out, we get an NPV of 5833, which is B. Aaron Chu is reviewing a profitable investment that has conventional cash flow pattern. So conventional cash flow pattern just means you have an outflow in year 0. So outflow, and then everything from year 1 onwards is all inflows, net cash inflows. So like an unconventional pattern would be something where you have like an investment in year 1 or in year 0, and then in year 1 maybe you have you get some cash in, but the net outflow gotta make another investment is still out. And then maybe year 2 it's an inflow, and then year 3 it's an outflow again. So this is an unconventional pattern, and it makes it a bit trickier when calculating IRR, because in instances like that you could have a situation where you have multiple IRRs for one project, which obviously doesn't make sense. IRR of course is a percentage-based calculation, whereas NPV is just the present values, sum of all the present values. So anyway, if the cash flows for the initial outlay and future after-tax cash flows all double, so all the cash outflows double, so let's just say we have like negative 100 outflow year 0, and then 200 year 1, 200 year 2, and these double to negative 200, 400, 400. Chu will predict that the IRR would increase and the NPV would increase. Well, the NPV is going to increase for sure, right? Like if you just, obviously it's, oversimplifying, but if you were to just sum all these cash flows up without discounting them, in the second option, you would get what, 600? Call it, NPV, but we're not really discounting, so it's not really NPV. And then here you would get, what, 300, right? So you can tell right away the NPV is for sure going to increase in the second scenario, but the percentage increase is still the same, or the percentage return is still the same because everything just doubled. So the percentage would still be the same. So our answer is actually that the IRR would stay the same and the NPV would increase. Catherine, whoever, is an energy analyst tasked with evaluating a crude oil exploration and production company. The company previously announced that it plans to embark on a new project to drill for oil offshore. As a result of this announcement, the stock price increased by 10%. After conducting her analysis, Catherine concludes that the project does indeed have a positive NPV. Which statement is true? The stock price should remain where it is because her analysis confirms that the recent run-up was justified. Well, no, but we'll get back to it in a second. The stock price should go even higher now that an independent source has confirmed the NPV is positive. No. see, this is the answer, right? The stock price could remain steady, move higher or lower. So the whole theory around NPV analysis, and I mean stock prices in general, is that the value of a stock is a sum of its future cash flows, right? So a good example of that is when you see these, you know, stocks with really high dividend yields on the last day of trading with the dividend, like with the quarterly dividend, typically the stock will trade lower. Like if you hold everything else equal, like there's nothing going on in the markets, there's no news, like everything's real, like just all else equal, which of course what would never occur in the markets. But if you hold everything equal, the stock's price should theoretically decrease just by the amount of the present value of the dividend that's going to be received, right? But that doesn't really happen in practice because there's a bunch of moving parts. There's some behavioral biases involved in investing. Like there could be macro risk, there could be company news, there could be stuff going on in the industry, whatever. Um, so the whole idea around the NPV analysis coming, kind of circling back, is that, like I said, the stock is the sum of its future of the present value of its future cash flows. So if an NPV, if a company's engaging in a project and the NPV is positive, then like theoretically the stock's price should move proportionally to adjust for that increase in NPV. Um, but there's also other things going on, right? Like whether or not this is a positive NPV, sure it's good, but there's not a lot of context here. Like what is the NPV relative to expectations in the market? Like, okay, sure, great, it's a positive NPV, but is it a million a positive NPV? Is it 100 million? Is it 250 million? And what were analysts expecting? What was guidance for the most recent quarter, right? So if it's lower than expectations, stock's probably going to drop. Um, and that's like one of the factors. There's also, like I said, a lot of behavioral biases. Like there could just be a lot of trading activity that day. There could be, a bunch of stuff going on. So just by having a positive NPV doesn't really mean much. It has to align with expectations and combine that with other factors, and the stock price could stay the same, move higher, move lower, whatever. There's a bunch of other factors than just this drilling for offshore project. All right, we got two investments here. They have similar outlays, but have different patterns of future cash flow. So we can see like we both have $50 up front, and then some of them, investment two gets the return in year four. Investment one has $20 every year. Um, so we have this information for both investments. The required rate of return is 10%. Okay, so similar discount rate. And then we have some NPV stats and some IRR stats here. So this is what we're going to be focusing on. The two products are mutually exclusive. Okay, this is important because mutually exclusive means that it's either or. So it's either investment one or investment two. So you can't have them both. You can only choose one or the other. So based on that, what is the appropriate investment decision? Which one should they invest in? Well, in the case of mutually exclusive projects, you always take the one with the higher NPV, not the higher IRR, because higher NPV should theoretically bring up the company's value more than just um, than a project with a higher IRR but lower NPV, because this 1830 in investment two versus the 1340 in investment one should cause a greater increase in the company's value. Um, so for mutually exclusive projects, just make sure that you're always taking the one with the higher NPV. In the event that these weren't mutually exclusive, like let's say the company had the capital, had the resources, had, everything aligned to be able to do two at the same time, then they should, obviously engage in both, assuming that, their IRRs is higher than their cost of capital, greater than their hurdle rate, worth their time, etc. But for mutually exclusive, take the higher NPV always. All right, last one here. We have two investments. The cash flows as well as the NPV and IRR for the two investments are given. So we have different cash flows. Once again, investment two, everything in year four. Investment one has 4 years of cash flows. We have NPV slightly higher for investment two, IRR higher for investment one. and we're asked, oh, and we're given the discount rate of 10%. So what discount rate would result in the same NPV for both investments? Okay, so this is a bit of a weird one. To actually solve for this rate, it's, understandable that they're not going to ask us in the answer like which exact rate it is. I don't like you would, to my knowledge, you would need Excel to do this and do like a what if or goal seek or something. Um, but based on the information here, we can kind of figure it out, right? So I'm going to start down here at C. So we have a rate between 15.02 and 16.37, which are the IRRs of both projects. So if if we're taking investment two and we apply a 15.02 discount rate, which recall that the IRR is the rate that sets NPV equal to 0, right? Then we would get, so using 15.02, we would get investment one NPV, so investment one and investment two. So the NPV here would be 0, right? We know that. Then for investment two, it would be greater than 0 because the discount rate of 15.02 is less than the IRR, right? So it'd be greater than 0. So if we move up this list to 1637, so then if we use the discount rate of 16.37, um, the NPV investment one's gonna be less than 0 because we're using a higher discount rate now. And then for investment two, it's gonna be 0. So they're not equal in this range, right? So scrap that out. Then we're left with a rate between 0 and 10 and 10 to 15.02. So we know from the question that this NPV metric here, these NPVs, we're using a 10% discount rate. So for investment two, if we were to apply, so let's continue with this, right? So we're at 10%. Investment two is 19.53, and investment one is 1412 NPV. So if we applied a lower discount rate, so let's say like 5%, this NPV here would be even higher. And then this NPV here would also be higher, but not by as much, right? So there's going to be a difference in this range as well. So that's not our answer. The answer is going to be somewhere in between the 10% and the IRR of this calc. The curriculum actually gives you the number of like 13%. In the answers that makes these NPVs equal, but obviously outside of the scope of that question, you could have just figured it out using the logic that I showed here.